Silver Dave here, coming to you with another video. Well, I've been working on this thing for a long time, and let's find out what I found. I've been working on this machine learning program for a while, and initially I picked up some it was like I picked up a tutorial from on the internet from some guy's blog, and he posted an article about how he was trying to use machine learning to do some predictions for gold prices. And where he was mainly using was basic market prices and also different stock markets. And I was thinking maybe we can improve upon it and add a little bit some other stuff like different currencies. We can add like Bitcoin, cryptocurrencies, and we can add more individual markets rather than looking at indexes of emerging markets. And when I did that, I started getting some weird results. You know, I was getting before I added that, I had similar results as an original author. But when I started adding more data and I tried using the similar machine learning algorithms to make my predictions, I was getting some really off results. And then I realized that maybe with the added data, some of the algorithms would not work as well. And so I decided to start tuning and rebuilding basically the prediction stack and blending my models and all this other stuff. I'm gonna spare you the details and look at what I was really getting when I was comparing the different models. And when I started adding things like RSI, more exponential moving averages, MACD, and all of these directional information, one of the algorithms I was using previously, which was the nearest neighbor regressor, it performed poorly with such data. And I don't know why it performed poorly. Maybe if I tuned it, I can try and fit it better to the data, but it would be relatively computational. It would take more time for me to do it. So I decided to go with the top models of how you can estimate prices, and basically the best models were extra tree, cap boost. Anyways, these are sort of decision tree regressors. A cap boost regressor is more like I believe it was developed by Yandex for search engines, so it's a mix between a regressor and then there's also a classifier version, and somewhat similar to nearest neighbor, but it's also different, but it tends to work better with the data I was supplying with for it. And I was getting decent, better numbers. And so I decided to create new stacks and blend my models together and so on. And I found that, overall, it was always extra tree regressor, cap boost, and gradient boost machine. And using this information, I decided to rebuild new models. And basically, as you can see, I was building them out and so on. And while I was doing this, I was thinking, okay, I added new information to my analysis for the price of gold. And when you look at the original author's work, he mentioned that, the main thing that affects the price of gold is the moving average, 180-day moving average. So if gold was moving in one direction, it tended to revert to another direction. And also the emerging markets index, because people would cycle their gains from emerging markets into gold and balance their portfolio for portfolio balancing reasons. I think that part of it is true, but it's not what I really wanted to look at. I wanted to sort of create something where we can have a little bit more visibility on the price of gold. Because when I use his original model, right, there were at times, especially in recent times, with so much volatility, it would just deviate completely. It just no longer made sense. And I was thinking maybe there's something better in the market information that can that can give us a better benchmark. And I decided, I didn't know what it was. So before, when I tried to build his, he also has a crash classifying model. And when I was working on that, I was looking at what I was getting out of, and I added MACD for every single ticker item and RSI and all the directional information. And what I found was that the direction of the Swiss franc was more sensitive to the direction of, was sort of like a leading indicator in terms of predicting the direction of gold. And I was like, that's interesting. So why is that? And I thought about it, and I was thinking, maybe it's because of risk, that people tended to have, see the Swiss franc as a, an important feature in sort of, as a safe haven. And they'll buy the Swiss franc before they actually bought gold. And the direction of Swiss franc is actually a good indicator of the overall risk sentiment of the market. Not so much the risk of a specific asset, but how people felt about risk at a specific point. And I was thinking maybe, and I saw the 50, the short period MACD of 50 to long period 90 play an important role in the crash classifier. So basically, it's a gold price crash detector, and I saw that was one of the main features. And when I put it into my regressor to analyze the importance of the features, it was also one of the top ones. But it also pulled up other thing that was also related to the original model, like emerging markets. Like the emerging market direction and where it was most likely going to go. Also, it was quite sensitive to the Swiss franc and also short-term movements of the Swiss franc relative to the dollar. It was sensitive to Bitcoin. I was like, why is Bitcoin a feature in it? I was thinking maybe Bitcoin is a feature because, Bitcoin, people buy more Bitcoin when they have more. They're like more willing to have risk in terms of their sentiment, how they feel about risk. And when people feel good about risk, they tend to buy more Bitcoin. And there's a sort of inverse relationship between Bitcoin and gold. So I was like, okay, this is very interesting. Maybe I'll get a better prediction model. And I started building this out. And well, I got a better model out of it. I retrained my models, and it took quite a while to get everything down, because every time I had to make one model for one predictor, I had to test it and see if they were giving me out, I would say, not so much like, not always like correct results, but consistent and results that made sense, right? Because they can't see into the future. They can only see today and tell you what might happen in the future. And I was thinking, okay, let's see what we get. And this is what we got. So initially, when I did, for example, something like a 7-day prediction, right? This is my 1.5 version. On the 7-day predictor, especially on the recent days, it kind of just tanked, and it was all over the place. And when I did the analysis of the original model, which used the KNN regressor, it was very inaccurate. It was really inaccurate, and it tended to go a bit all over the place. And when I used the improved model, the new one, and I did the analysis, it was much closer to the actual evolution of the price of gold. As you can see here, this is the 3-day, the 7-day, it was very, very consistent. There was no inconsistencies in the model. And it was accurate. I'm getting close to 97.6% accuracy over for a 7-day prediction, which is pretty good. It's not the best you can get, but it's decent. And over a 3-day period, I'm getting 98.3. 14-day period, the average accuracy is 97%. So it's above 97% in terms of its prediction accuracy, and it's pretty decent. 96% for 21 days. 122 days. This one is also more accurate than the we call it the original model, which I believe is in the 70s. Let's see, 122 days. Let's see, how much was this one? Day 1 point, it's 85. And in the recent one, 122 days, this is this one, and this is 88. So it's like, you're like, oh, 3% is not so much. 3% is a huge amount of difference when you're coming to making a huge 112-day prediction. It's a huge improvement in terms of the predictive power. Basically, it's reduced the area between what the model predicts and what the actual results are. It's a pretty good result, and I'm pretty happy with it. Is it useful? How close is it to reality? Well, if you think about it, this model is quite close to reality. It's 97% accurate, and over the last few days, the last few predictions, it's been, I would say, 98, 90, almost 99% accuracy in some cases. And it tends to predict bull markets, like rises in prices of gold, pretty well. I think it has a slight upward trend bias. I don't know why it has an upward trend bias. It's possible that, maybe gold is undervalued overall, and it believes that gold should be valued more. And potentially, if you think about it, that could be true, because if you look at the S&P 500, today it's 3,700, and we go back to all the way down to pre-2008. If we go to 2009, 2010, we're at $1,000 and gold is at $2,000. So gold at that point probably was overvalued at $2,000. But today, the S&P 500, the relationship has inverse. The S&P 500 is extremely expensive relative to gold. It was the same here. The relationship, you look at S&P 500, the pricing of it when it was in 2007, gold was really cheap. It was like $500 or something. We're exactly at the same price ratio. And they tend to cycle in opposite directions. So, do I think that, these predictors are accurate? I think they are. They support a lot of the current, what you see in the market, right? If you go and you look at the dollar to the Swiss franc, especially the last few days, you can clearly see that we're in a downward trend. If you go back to April last year, the dollar was stronger than the Swiss franc. There was quite strong risk sentiment. People were happy about the economy. The economy was perceived as being strong. There's strong growth. There's, markets are doing well. And over time, especially after the pandemic, people are actually quite bearish about the market. I think overall the economy, they're quite bearish about it, because there are certain segments of the economy that will just never come back. And you can see that since, if you were to go back to 2018 and to trace out the MACD, it trades within the band. But since May 2019 till now, and maybe even further down to September 2020, 2024, we are on a downward trend for the MACD. And if the basically changes in the direction of the MACD in the short term tend to lead to corrections in the price of gold. But in the long term, if your MACD is trending downwards, consistently, the dollar is consistently being devalued against the Swiss franc. People's risk sentiment is not super strong. They're more in a wealth preservation mode. Then, yeah, you could see a long-term bullish growth in terms of the price of gold. Now, I don't know what it will go to. It's just that right now, the trend supports a growth in the price of gold because people are risk adverse. I don't know why people are risk adverse. It's kind of like, how would you say it? Like the machine learning program is kind of like trying to predict the price of gold. It's trying to look at ice cream sales, right, in summer. Like it can look at how many like ice creams were sold during summer and make a projection that, oh, it's going, it's hot weather because there's a lot of demand for ice cream. but ice cream doesn't cause hot weather. The seasons cause hot weather or cold weather. Other factors such as other things in climate change the temperature during the summer. Droughts cause hot weather, but it can see that correlation and it can say, look, people are ordering more ice cream before this period. Most likely it's going to be hot because everybody expects it to be hot and the expectation of people is hot. Right now, it sees a lot of risk sentiment amongst people, and people are pricing in as if they believe that there's a lot of risk. And it believes that gold in its model and in what it's seen will go up. And I think that is quite consistent with a lot of the predictions with a lot of different analysts. If you look at what they believe in. Do I believe that emerging markets are going to to go upwards? I don't know. I've been looking a little bit at the emerging markets data. I'm not too familiar about the emerging markets and how they move. I would have to look at it more. I've been looking more at the Swiss franc and gold because it's really the main relationship in this whole complexity. But also I've been looking a bit at Bitcoin. So let's see, pull up Bitcoin. And I do see that Bitcoin is in a high risk on sentiment since March. And I think the stock market too. But at the same time, it seems like a lot of investors are risk off. So, during this period from here till here, there was both risk. People were risk on and risk off, which can happen. You don't have to have everybody is risk on. But I feel like at this point, there's going to be a large quantity of investors who are starting to become risk off. Cooler heads are prevailing. They're looking at the overall market situation, and they're going okay, valuations in the stock market, like the DJI and the S&P 500, they seem a little bit ridiculous. Valuations no longer matter for some reason. Earnings don't really matter anymore. Basically, if you say earnings don't matter for companies, how the hell do you value the stock market? It's really difficult. And right now, people are expecting booming future earnings, but actually people are looking, but cruise lines and everything, they might never recover. They might take another, I don't know, 10 years to recover to previous levels. People will have to want to, bathe in water that other people have touched and everything. It's an interesting situation. Will cruises come back? Maybe, maybe not. Do people need cruises? No, people do not need cruises. Nobody ever needed to go on a cruise. It was fun and trendy to go on a cruise over the last few years. Cruise kind of made a comeback. There was a time, I think in the early 2000s to 2010, where cruises were not so popular. It was more seeing retirees going on cruises. But now, do people want to go on cruises? I don't know. I don't know if people really want to go on cruises anymore. And that might lead to, a whole industry being scrapped. And long-term unemployment and unemployment figures are slowing. There's gains on unemployment. Unemployment is going down, but it's going down slower. I think most economists are saying that, there's going to be long-term structural changes, and nobody's really pricing that in. They're not thinking, there is going to be long-term structural changes. Let's look at a little bit at how that's going to affect things, and people aren't really thinking about that. And there's a mortgage cliff, there's a rent cliff, there's a student debt cliff, there's all sorts of debt level. The debt level is getting really, really ridiculous for a lot of countries. And you're looking at it and you're thinking maybe one or two countries are at that indebted. It's maybe normal, but if all countries are that indebted and all individuals, that's a lot of debt. That's really a lot of debt. And there's no productivity if you don't have enough productivity to pay things back, then how do you pay back that debt? So yeah, that's people think that BTC is sort of the cure for a lot of things. I don't know if cryptocurrencies are a cure for a lot of things. I think cryptocurrencies have a place, but to think that BTC will be be a cure for everything, and that owning cryptocurrencies, look, they're just another currency. I mean, it's not processed by a bank, but it's underlying that currency. It doesn't change anything other than that it is currency. It will have cycles. It will be priced against other relative to other assets, and it's part of the system. It's not something that's outside of the system. But people love it, so that's a different story. Just like people love gold. I like gold, but I'm also realistic about a lot of things. For example, I remember telling everybody, you should look into buying some platinum, because platinum is relatively undervalued. It's really undervalued, some people. And I bought some platinum before the current rise, and I think platinum is going to just going to skyrocket. I mean, people used to be like shorting platinum all the time, and they're like, yeah, short pound, buy gold, or short platinum, buy silver. But if you look at what it does and where we're going in terms of macroeconomic wise, and the type of energies we're going to be using in the future, we're going to use a lot of platinum. They're going to need a lot of platinum group metals. Are we going to need more palladium? Maybe, maybe not. But I think platinum is a decent buy. Palladium dropped a little bit, but it didn't really drop a lot. It dropped from the real-time highs. If you bought palladium in June, maybe it will be okay, but it hasn't really gone down that much. Palladium, it's kind of on a I don't know how you even like put it. It's like yeah, palladium for me feels a little bit overvalued. There's one reason why palladium is being driven so highly upwards, is because there's not a lot of it, and it's used in a lot of catalytic converters, specifically for petrol. But that's one type of reaction. I think overall, if you were to take the whole platinum group of metals and look at what they are, basically catalysts for industrial uses, platinum should be around. It should be a little bit more than $1,000. It shouldn't be like, I wouldn't put it at $2,000, but I would say like maybe around 1,200, 1,300 would be where it would be trading around. Right now it's 1,000, so it's like, I would say it's relatively undervalued compared to the overall macroeconomic situation. It's been on a downward trend for the last, since 2010. Since 2010, it's been just like tanking. 2010, 2000, yeah. It's been just going down straight downwards. Like 2008, boom, down. Went up a little bit. 2010, boom. We're at the bottom. This is the bottom of platinum. Below $1,000 is platinum bottom. If you were like cost averaging and buying platinum during this whole period, you would have done very well. That's all I have to say about that. Let's see the RSI Relation Index, and let's look at weekly. Or we can look at monthly. Yeah, I would say it was around 700, 800, 700. It was pretty good points to buy. Now it's I think it's still relatively low, but it's not as low as it could be. You didn't buy in the lows. The lowest low would be in here by $800. It was completely undervalued. $800, $700 was relatively undervalued. This point is the bottom of platinum, and this is sort of just a little bit above the bottom. So if you're under this part here of platinum, I would say 1,100. This band is prices that you can add a little bit more platinum. I think there will be a little bit of a pullback on platinum, because everybody who were first movers has bought. They'll sell off a little bit before the end of the year, and then we're going to get back to a little bit more of a upward move. Like we can see that, February, December, people tend to sell a little bit more platinum. Um, yeah, once it goes down a little bit, I might buy in a little bit more, and I do like platinum. Platinum is one of the metals that I think is really undervalued, and I added an ounce. I wanted to buy another ounce, but it jumped a little bit. I might wait a little bit to see if it moves downwards, and then add a little bit more. And yeah, and I think overall the dollar doesn't have any strength. It's got, I think really doesn't have any support at the moment as a currency. The overall U.S. economy is very weak right now, and I mean currencies, they are related to the stock market, but also currencies are related to the flow of goods and services. And if you look at trade numbers, it does suggest that the dollar should weaken. And if the dollar weakens, there's a few reasons why it might weaken. There's the fact that people potentially don't really want to buy American assets because they see it as a risk. They also don't want to buy Chinese assets because they also see it as a risk. Because if you have two economies in conflict and they're the two largest economies, you don't want to put money into that because you don't know what might happen. So you do see that as a potential risk. And you look at Europe, it's anemic, like the euro. I mean, the euro is slightly better, but it is anemic. And you have the pound and the Swiss franc. They're just tiny. There's just so much Swiss francs. I mean, during this whole period, the Swiss National Bank is pouring money to make currency interventions to weaken the Swiss franc, and they're not succeeding because the Swiss market is so small and the risk sentiment is so big right now. So that's kind of like the counterbalance. Do I think what I would do next? I think the next step for me was relative to the machine learning program is I am going to make this for silver because I stack silver, I also stack gold, I stack platinum, but it would be interesting to see if I can make a short-term predictor for silver to help people, figure out where are the sort of the bottoms of silver, when they can go in and they can be relatively safe to buy a bit of silver. Because I know that like it's really painful if you don't have, let's say if you're like $400 to buy silver and silver is so volatile, it just goes up and down all the time. What time, when should you buy? It can make a huge difference when you're buying silver because it can move like 5-6% in one day. And if you bought it a day before, you got 5% discount. You bought it a day later, you just took like a 5% hit. So in the long term, it doesn't really matter. But if you can optimize a little bit, then yeah, that could be a good project to work on. I think the next part, because one of the things that these models fail at is it's pretty bad at predicting crashes and downward trends. For upward trends, when it's at the downward trend, it tends to predict them quite well. But when it's at a peak, it tends to not do so well at predicting a downward trend. And I'm working more on predictors for downward trends rather than predictors for upward trends next. And so when I combine the two, hopefully, like it gives a better picture of where the market might move. It doesn't predict like why the market moves. Like these things, like I said, it cannot tell you like, oh, gold is going to go up because treasury interest rates are going up. I actually think the treasury rates, they move so slowly and so little that it doesn't explain a lot of the volatility in gold and silver and a lot of these other currencies. I think it's more risk sentiment that explains better the medium term and the short term movements of gold. Even the long term, like the long term risk sentiment explains better the movement of gold. I think there was a time when treasuries explained better the movement of gold because treasuries were a better measurement of risk because there was no central bank intervention in the pricing of treasuries. They were market decided. So people decided on it based upon their feelings and how much they wanted to buy it for and so on. Now it's pretty much a fixed price asset. They fixed a specific price for it, a specific interest rate for it, and It's not so interesting. You can't really, it doesn't price anything and doesn't represent anything. It represents a tool that the central banks are using to inject money into the economy. And that's very different. If you're trying to price towards that, your models are not going to price anything because it doesn't reflect people's choices. So that might be one of the reasons why I don't really actually see treasuries be noted in these models from this point onwards. I'm not talking about like maybe 20 years ago. I'm not talking about 10 years ago. I'm talking about the last 6 or 7 years when we have direct intervention in bond markets, or pseudo direct intervention. They're not really intervening. They have special vehicles, all these central banks, that they use to intervene in different markets. But there's heavy intervention in these markets and they are distorted. So they're not such great proxies to measure the price of gold. And like I said, my theory is that the price of gold, it's not related purely to cash and the monetary mass of the United States dollar. It's related to the risk perception that people have of the dollar and other currencies around the world. And it's a sort of, it grows when there's a risk off sentiment, like the price increases. And when the price decreases, there's a risk on sentiment. And the more I look at the data and the more that, the indicators that come up to say like, okay, the Swiss franc, there's a relationship with the Swiss franc and gold. Bitcoin also has a pronounced relationship, emerging markets. I'm like, okay, these things, they're not directly related to each other. Like emerging markets are not related to Bitcoin. Like, there's no like direct relation. If you look at any classical study of portfolios and stuff, they will never put Bitcoin and emerging markets together. It's rare to see some of the, at least when I was studying in uni, when I talked to some of the professors and I was looking at some of the data, there was no Bitcoin and it wasn't related. And of course, gold, there were different currencies might be explained relative to bonds and the interest rates and trade flows and so on, but not so much relative to risk sentiment. And I think back then there were no stock markets that had that could be like priced like Amazon but not have any actual earnings. They have earnings but not actually be profitable for so long, or Tesla, like no profits, like crazy stock valuations. It would just not be possible. People would never would not exist in the market. People would tell you that's a bubble and it's insane and it's called Enron. They're cooking their books. That's what they would say. That's what it was called. But nowadays, they don't even need to cook their books. They just say we don't have earnings, but we have a bright future, and people will just pour money into it. And that's the definition of a bubble. That's like saying me telling you tulips have a bright future, and you pour all your money into it and believing in the tulip future, and people believe that tulips will go to the moon, and tulips are the best thing in the world, and we will all trade with tulips, and tulips will replace currencies because it's a excellent commodity, and it has inherent inflation because tulips rot. It has natural inflation, so you don't even need to print currency. I don't know. I'm just like sprouting stuff that if you don't know about it, the bubbles. People always rationalize bubbles. I think the stock market is relatively bubbly. I wouldn't say that all stocks are bubbles, but the stock market is bubbly right now. And I think one of the culprits is the ultra low interest rate and the overall, I would say, money distribution through quantitative easing. That's kind of the problem. I think they did the study. If you give it to, if you actually give money directly to banks and institutions like they did in 2008, it doesn't tend to go back directly into the economy. It just goes and creates big bubbles in the stock market and different assets. And I think that's pretty true. And if you look at, I don't know, like if I look at right now, the price of gold relative to the stock market and to other assets, in the world, buying a unit of gold for 1 ounce, which is 1 ounce, it's relatively cheap to other assets out there. Like to real estate is cheap, to stocks is cheap, to Bitcoin is cheap. It's really like, yeah, it gained a little bit, but it's so undervalued overall. So it could go to zero. Silver is even more undervalued. So there's people are not buying it. They think that it's crazy because over the last year you bought in 2013, yeah, you lost money, but at this moment, the price of silver, it's really undervalued relative to everything else. And but of course, if you bought silver, for example, in 1990, yeah, you made money. You made a lot of money. And potentially, if you buy silver now, it seems to hold itself pretty well. Actually, I've seen less volatility in the silver market compared to the gold market, which is quite interesting. Because gold over the last few days, it's been moving a little bit more like silver rather than gold, and silver has been moving. I mean, it's been moving, but it's not moving as much as I thought it would. And platinum has been shooting upwards because people announced that there's a platinum shortage. But even the recent moves, I would say they're more corrections to what platinum was, to the real bottom of platinum. And platinum, I think under $1,000, it is ridiculously cheap. It's just ridiculously cheap, platinum under $1,000. I mean, if you look at the big picture of platinum, yeah, sure, it went down to 700 and went back up. Even if it grinds sideways, you just hold it for a few years. Demand for platinum will come sooner or later. It's the second it hits, it just shoots through like palladium. The only reason why demand crashed here is consumer vehicles for diesel engines. So our Dieselgate here, in 2011, 2012 happened, but otherwise it should be pretty much. It should be relatively bullish on it. I do note one thing about the platinum market. One of the things about platinum market is there's no hype. There's no real hype around the platinum market. People don't hype platinum a lot. There's no news on platinum. But one of the things I noticed is that it's quite correlated with the overall, I would say, stock market, because when speculators come in, platinum shoots up, and it shoots up really, really hard. I would say at this moment, platinum is very, very undervalued, and potentially what we're seeing this movement happen again. It could go down further, but I think we've seen it go down already, and when people start buying platinum for, I don't know, vehicle purpose industry, speculation, and so on, this will move upwards. Platinum just needs a sort of a demand, and platinum demand in the future could come in the form of fuel cells. There are quite a few electrical vehicle companies and mainstream companies focusing on hydrogen fuel cells. And you're like, why is hydrogen fuel cells better than batteries? There's a reason. I mean, hydrogen fuel cell vehicles are still electrical vehicles. They use hydrogen as the source of power, and they use a catalyst to basically cause a chemical reaction, create electricity in the fuel cell. And actually, it's just a different type of battery if you really want it. And instead of storing it within lithium and making a rechargeable lithium, they store it in a chemical form and they convert it into battery power, right? And there's a catalytic reaction when they're doing that. That type of power is quite clean, and it's easier to fuel than lithium batteries. A lithium battery is hard to fuel because it's a solid state item, and you're pushing electrons into a solid item, and then it gains an unstable state. Basically, it's kind of like inflating a giant balloon, and you hope the balloon doesn't blow up because it's in a tiny, tiny space. It's held together by metals, and it's under high pressure, and then you turn it on, and then the pressure slowly, you have a little valve, and you're like small amounts of pressure coming out, but it's quite heavy. it's unstable. Batteries do explode. If you pierce a fully charged lithium battery, for example, on a Tesla, it will explode. I'll put a picture up. I'll put a link down when you see one of the Top Gear guys. I forgot his name, but he was driving an electric sports car that crashed, and pretty much it just almost burned him alive. He was lucky he escaped, but yeah, when you have a battery car that it's almost as bad as hydrogen and petrol if there's something goes wrong with the fuel cell. Hydrogen the same. I mean, it's explosive, but you already put explosives in your car and you actually turn on to make them explode. It's called petrol, and then you have igniters in your engine that ignite the thing, and it makes mini explosions. But overall, when they're engineered well, they are relatively safe, all of these things. And safety can be achieved through engineering solutions. But they take investments, and the problem with lithium, very similar to battery before, is that, with hydrogen, is that there's no charging stations. Nobody has really invested in commercial charging stations. Potentially one of the first places, like I think Honda has a good strategy, is to focus on long distance transport, which battery power long distance transport trucks are not a viable solution. Like they're just not viable. And and Platinum's using diesel and fuel cell, so there is potential demand on that side, especially for, I would say, heavy duty trucking and the future of trucking. And eventually, if that is widely adopted, it could be a potential, I would say, mover for increase of demand for platinum, and also later on maybe commercial vehicles for individuals. Anyways, I went on a bit long. I went on a bit of a rant about what I'm building. I'll share with you guys the latest predictors, and yeah, thank you for watching. Click the like button if you liked. I'll be working on the silver predictor, so next, and also a crash predictor for gold with the data sets I have. Thank you very much for watching. Have a great day. Dave out.